Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Ed Carlson. Carlson is author of George Lindsey and the Art of Technical Analysis, published in English and Japanese, and also an Aide to Timing. Carlson is an independent trader, consultant, and chartered market technician based in Seattle, Washington. Carlson is a contributor to Technical Analysis of Stock and Commodity Magazine. He also manages the website SeattleTechnicalAdvisors.com, where he publishes daily and weekly commentary. He spent 20 years as a stockbroker and holds an MBA from Wichita State University. Longtime listeners will recognize Ed, as he was also host of Conversations for 3 years. So I am honored to have him on the other side of the microphone today. Welcome to the program, Ed.
Good morning, Lance. 3 years. My God, I didn't realize it. Time went by fast. That was a lot of fun.
You did a great job and did a great service for the MTA. A lot of hours go into preparing and doing these interviews.
True. Thank you.
Yeah, we greatly appreciate your service. So you just published your second book on George Lindsey called An Aide to Timing. Who is George Lindsey?
Well, who was George Lindsey? Lindsey passed away in 1987. He lived from 1906 to 87. And he was, despite the fact most people today have never heard of him, he was actually quite well known during his time. He wrote his newsletter for 33 years, roughly, I want to say 1951 to, somewhere in the 1980s. He was often quoted in the New York Times business section. He lived in New York City. He had a couple of appearances on the television program Wall Street Week with Louis Rukeyser. So in his time, I'd say he was relatively well known. The one mistake he made was that he never wrote his own book, at least not on his market timing methods. And so without that, his legacy was pretty much disappearing, or had disappeared, until I took an interest in his work and was able to find enough of his old newsletters to put together a couple books.
How were you able to come across work that was so dated?
Yeah, that's always a challenge, and frankly, it could not have happened without the kindness of strangers. A lot of people may know that Investors Intelligence has a small collection of his old newsletters, some of the more important ones actually, and if you call them up and remind them that they've got them, they'll Xerox them and send them to you for a price. That's what I found. They didn't even know they had them the first time I approached them. I myself, I learned about Lindsey when I was sitting in your chair doing a podcast interview with Peter Eliades. And during that interview, he mentioned Lindsey's name, and I stopped him and I asked him, well, who's George Lindsey? And we probably went on longer on that topic than we should have. But he's the one that told me he thought Investors Intelligence had some of those old newsletters. So anyway, I came up with the idea for a book based on that. And when word got out that I was writing the first book, newsletters started coming in, from people who were kind enough to help out.
Why does his work resonate with you?
That's probably a very personal question that won't mean a whole lot to anybody. Well, maybe it will. I don't know. But I like it because his work, to me, transcends the current focus in technical analysis on mathematics. I mean, it uses numbers, don't get me wrong, but it seems to say there are certain constants in the world that are forever, and I'm specifically referring to his standard time spans. Some things don't change, and I kind of like that.
So why don't you walk me through some of Lindsey's work? What is his platform? I mean, the title's certainly catchy, An Aide to Timing. So we're timing the markets clearly. Walk me through some of his work and his forecasting tools.
Okay. Well, and you know what? Maybe the best thing to do is just walk through the current forecast. and explain the tools as we go along. It's always kind of hard to do that in an audio presentation without any charts. But
can you put up a chart for me?
Yeah, you got it. Yeah. Well, okay, so you have to start from a place that everybody agrees on, and hopefully everybody will agree that the October 2007 top was the end of a bull market. Well, as everyone I'm sure knows, the market went down until March of 2009. And here's the first key when using Lindsey. He talks about basic advances and basic declines. And the time period from October 07 to March 09 does not fit any of the time spans. Lindsey wrote that after a bull market top, you almost always get a bounce 13 to 14 months later. Well, that just happens to be the time span of what he called a long basic decline, 376 to 446 days. And Lindsey's principle of continuity says that when you get to the end of a basic advance or decline, you start counting the next, in this case, advance immediately. The fact that the market went on down into March of 09 is really immaterial. We're going to start our count from what he called a secondary low in November of 08, November 21st, 2008. And from there, we try and piece together what are the basic advances in order to time the top of the bull market. Well, first of all, that's not where you would start. You would start with the long-term intervals. And I'm already getting into probably too much detail for most people. But the long-term interval says you look for a top, market top, somewhere 15 years to 15 years and 11 months from an important low. And that takes us to the time period, if I remember, somewhere between last October and September of this year. So we're looking for a top somewhere in this time period. And on the theory that we probably already are losing people, I'm going to stop right there.
So let me just recap. That November 2008 area is a starting point for a projection of a turning point. Did I follow that correctly?
You did. We're going to start counting our bull market from there.
Okay.
So
I am tracking with you. You didn't quite lose me.
Okay. All right. Well, let me throw one more thing in there. That low to the February 18, 2011 high is 819 days, I believe. That fits his time span of a long basic advance. Those are 742 to 830 days. But that top did not fit into a 15-year interval. Okay? This is what Lindsey called a sideways movement. And typically, we would expect the market to go basically sideways until we got into that time period of a 15-year interval. And then to go down. And by down, I don't mean that correction we had into October of 2011. I mean a real bear market. Mm-hmm. Because the sideways movement is a topping formation. In this case, we advanced out of that topping formation. Lindsey wrote that there had only been 2 instances in the entire history of the Dow of this happening. In the 1880s and in 1926-27, we saw a sideways movement that we had an advance out of. That implies that the coming bear market after we get to the top is going to be a true wealth-destroying, career-ending type of bear market. And you've heard this from a lot of different approaches to technical analysis, so this just fits what we hear from a lot of other folks as well. So I thought that was interesting.
So we're not necessarily in uncharted waters, but it's rare what you're seeing right now.
Correct. So we counted the first advance from November 08 to February 11, and here's where the second book comes in. That to kind of backtrack, how did I come across his work? After the first book came out, Sam Hale, who I believe is an MTA member down in Atlanta, and he's a retired professional technician, he sent me an envelope of old Lindsey newsletters that he had kept for decades, which is what, that's what anybody had done, that had sent me newsletters. which I think is a testament to Lindsey just in itself, that someone would have kept that stuff for that long. Anyway, I got this envelope in the mail one day, and there, lo and behold, was the paper Lindsey had written in 1950 called An Aide to Timing. I had often found references to this work in the other newsletters, but had never been able to find a copy. Well, it really was the key to the whole approach. And this is what I've got in the second book, An Aide to Timing. And it's with this book that I realized that the October, let me think here, the October low, oh boy, I don't even have a chart in front of me. I should have that up. Well, let's let's say this really made all the difference in trying to figure out from where do we count these advances. We always count from a secondary low, so the November 2008 low was easy. That was an easy one. But then the question became, well, where do we count the next advance? Because we've already exceeded, with February 2011, that was definitely the end of that advance. And so it's the information in the new book that really ties it all together.
So what I don't think I heard, when are we expecting the top and then this wealth destructing decline?
Right. No, you did not hear that. It would appear that that we're right in line with that right now. So for example, we started with the 15-year interval, and that told us somewhere between last October and this September we'd expect this high. And then we had to know from where do we count the next advance after that first one petered out in February 2011. Well, I got a chart up while you were asking your question. And our middle section count told us the basic cycle ended not with the October 2011 low, but with the next low on November 25th, 2011. And it's from there that we're counting what ends up being a subnormal advance, 414 to 615 days. And that should line us up in the current period, sometime between now and I want to say July. So to finally narrow that down, then we use the counts from the middle section. And that's a large part of the second book as well. It really goes into a lot of detail that I didn't have available to me for the first book. And that's, it really looks like the highest probability, it points to this Sunday. And with these counts from the middle section, despite the fact that they've often been exactly correct or only off by a day, I usually give them at least a week either side. So I'm thinking either this week or next we should see a top in this bull market top I've been looking for.
Okay, and this is being recorded March 7th, so you're looking the week of March 10th to the 15th-ish, 2013, okay?
That's right.
We'll give it some leeway there. And I guess that leads into a question on what time frame does this method work? And I guess I don't mean to put words in your mouth, but it sounds like you went from real macro. You were talking about 15-year. You would use 22-year in your book as well, and you narrowed it down to a week, plus or minus a day. You even mentioned. So,
yeah.
Did you already answer that question on what time frame? It sounds like you can really zero in on it.
Yeah, I'd like to describe Lindsey's approach as kind of a funnel approach. You start with a wide net and consistently narrow it down using his different models, making your target narrower and narrower until you finally get down to a point forecast, which, don't hold me to a single day. But, I found a lot of people get upset when you come up with a point forecast, and then even if you're off by a day or two, they say you failed. I don't see anything in life that way. And so, like I say, we have a point forecast, which is for Sunday, this Sunday, the 10th. That obviously is not going to work, being a Sunday, and the market's closed. But sometime within a week, either side of that date, that would, and hey, if it goes for 7 or 8 days, one way or the other, don't shoot me, right?
Other alternate options available to that if something doesn't go according to plan?
Well, that's what I'm always looking for. And the biggest challenge is just figuring out the system itself. I mean, quite frankly, it's been a learning experience for me. I've had my share of mistakes. trying to figure out where this bull market was going to end. But the biggest help has been the information in that paper, An Aide to Timing. But once you get the counts figured out, you shouldn't be off by too much. I'm at a point now where I can't find another middle section that points to a date within the standard time span I'm looking at, which fits the 15-year interval. So I feel like I'm kind of out of alternatives here, and really do expect it to be sometime here in the next week or two.
Okay. Does Lindsey ever explain why the relationship between these periods work? I mean, the November 2008 wasn't the low. I mean, the March 2009 was the low. So this was the secondary low that you called it. Why would that relate to a high in the future? Does he ever explain those relationships?
Only to say that these intervals have occurred throughout time. I've already mentioned the standard time spans. He said he writes that all advances and declines have fit into these intervals, and if a person was truly interested, they could find a list of them at my website, seattletechnicaladvisors.com. It might be more easy to understand. He's also written that a 107-day interval and a 221-day interval, these two particular intervals have shown up throughout the history of the Dow, and all you have to do is be aware of them, and all of a sudden you'll start seeing them everywhere. It's really fascinating, and this kind of takes us back to your question of why Lindsey resonates with me. It's this feeling that there is some predictability to not just the markets, but indeed the world. The only book Lindsey did write was called The Other History, and he attempted to show that there are these time intervals that have existed throughout history, not just the markets. Anyway.
Does Lindsey use any price target tools along with his timing tools?
Lindsey's primarily a timer, which I guess that's actually another reason it appealed to me. You know, so much of what's done in technical analysis today deals with price, and yet we call ourselves market timers. But yes, with his three peaks and domed house pattern, he had a system he called the tri-day method for forecasting the price, price bottom, the price as well as the time. And but it has to be used with the three peaks domed house. And frankly, I've found it's kind of a hit and miss approach. It's amazing when it works how close it is, but it doesn't always work. So I've got it explained in the first book, but it's not something I spend a lot of time with.
Okay. So as a point of, I guess, practical trading, as I'm looking at the market right now, the S&P cash is trading at 1544. What level would you look for confirmation that the top was in on the S&P?
Well, based on Lindsey, nothing. We're looking at time.
Okay.
But if you're asking Ed, I'm looking for a high somewhere between 1540 and 1580. I really think that'll be the top, and that's based on a bunch of Fibonacci projections.
Okay. So where would you take your short position in that range? We're already in your range, so you're accumulating short positions here, or do you wait for the bottom? Do you wait for it to start going down before you...
Oh, I've learned that lesson the hard way so many times. I'd wait for it to start going down, and that's probably the basis of a whole nother conversation, and you've probably got guests who do it a lot better than I do.
Sure.
Or at least I hope you do.
Where can listeners buy a copy of George Lindsey's An Aide to Timing by Ed Carlson?
Yeah, Amazon.com. You can find the first book there, The Art of Technical Analysis. You can find the new book, An Aide to Timing. You can also find two DVDs I've created. One is specifically on Three Peaks in a Domed House, and the other is just an introductory DVD trying to give people kind of an overview of what Lindsey's about. That's called An Introduction to the Work of George Lindsey. And I'm currently working on a third DVD that should be a companion with the new book called An Aide to Timing. But that won't be out for a couple months. Okay. And those are all at Amazon.com.
Well, I always like to give the guest the last word. So is there anything you'd like to add before we go?
Well, I appreciate that. I don't get that opportunity to have the last word very often. I'm not here at home anyway. No, I think we went through it. I hope I didn't leave anybody in the detail. There is a lot of detail to this stuff. I would conclude just by saying using Lindsey is like a crossword puzzle. Most people today in our linear thinking world, that's how I like to think of it, call it anyway, think, well, if I get A right, then that'll take me to B and that'll take me to C. With Lindsey, A may work, you know, you may find a word that works in the horizontal row in a crossword puzzle, but if you can't get B to fit that, a good vertical word to fit the horizontal line, it's just not going to work. And so it's about iterations, going back and doing it again. Primarily, it's not the chore it might sound as long as you know the rules, and those are all spelled out in the books.
Okay. Today's guest has been Ed Carlson, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.